So hello, everybody. My name is Philippe Mueller, and I'm a professor of finance at the Warwick Business School. And I'm also the module leader for the financial markets and financial risk management module in the global central banking and financial regulation qualification. We're here today to discuss some of the key topics that arise in the module and how the content of the module relates to some of the challenges that people in central banks face, and when it comes to managing and supervising financial risks. I have here with me Lorenzo Brecher, who's a co-module leader, and he's currently an assistant professor of finance at the University of Lausanne, and Pelagio Neokleos, who's at the Bank of England, the senior policy advisor for financial stability, strategy, and risk. Let me just kick this off with the first question for Pelagia, namely to discuss a little bit why you think it's important that employees of the bank or central banks in more general across different groups have a solid knowledge of both financial instruments and tools to manage financial risks.
This model was developed first and foremost because financial markets are a core part of the financial system. And in fact, in periods of stress, they can act as a shock amplifier. So for us, understanding how to estimate, price, and manage the risks from financial markets, as well as the behaviors those who participate in them, is crucial for our objective to protect and enhance the stability of the financial system. Now, let me explain a little bit better what I mean. So when most people hear about financial markets, they think of it as something that is distant from their day-to-day life. It's something that goes up and down, and occasionally it blows up. But actually, financial markets play a very important role in the economy. They finance government and corporate debt. They support infrastructure, energy, trade. They provide means for businesses to hedge and create more certainty around their cash flows. They give us the opportunity to invest and grow our savings and pensions. But we've seen many episodes in history where actually financial markets act as shock amplifiers. A very recent example that I had to work at the moment is the crisis in UK gilt markets driven by leverage LDI investments.
It seems rather obvious that, well, on one hand, questions regarding risk management are quite relevant to managing the financial system and making sure that there is some resilience. And at the same time, it's also clear that this is more a topic, or the topics relating to risk management are more on the quantitative side. Now, to be very clear, what we're trying to do here in this module is we're not here to train quants, okay? Very often in financial institutions, the pure quantitative functions are filled with people that have a background in physics, mathematics, even PhDs in these topics. Now, when it comes to financial regulation and oversight, it's not necessarily the case that people need to have a solid understanding of the intricate details of the models, but they need to understand what the models are there for, how they're used, and more importantly, what are the relevant inputs. So it's more what we're trying to do in the course is to convey how these models work in a more intuitive way. There's a bit of technical requirements that we're going to teach throughout the course, throughout the module, but it's more relevant to understand what are the necessary assumptions, and then for students on the module to understand what are the right questions to ask to those people that work on a quantitative side. Because at the end of the day, if you work in a central bank, you will have to oversee and understand what's happening in the financial sector. I'm going to pass it on to Lorenzo to highlight a little bit more how some of the academic concepts we discuss in the course relate to real-world examples.
All right, thanks, Philip. Yes, as Philip already pointed out, this is supposed to be a course that allows students to have an intuitive understanding about how financial markets work, why they exist, how risks build up and eventually unwind in these markets, but also how one could use these markets to manage risks. And due to this particular focus on risks and the management of risks, this course naturally has a bit of a quantitative backbone. Our approach in this course to risk management can be broadly grasped in 3 steps. Okay, in the first step, we will discuss various models. So that's more like the quantitative flavor of the course that allows us to quantify financial risks present in markets, in financial markets. As will become clear, hopefully, during the course, this is a very important but also very difficult step. As every model we write down is a simplification of reality and rests on more or less restrictive assumptions, we will naturally have to discuss when a model is appropriate and when it is not. And that's exactly what Philippe was alluding to before. Okay, unfortunately, models typically fail when we least like it, right? And it is important to mention that the model per se is correct and sound, and that's also sort of repeating what Philippe meant before. However, the assumptions the model is built on might break down. And exactly, I had the same example in mind when essentially going back, that takes us back to the financial crisis, when, you know, like the pricing of these CDOs, these asset-backed securities that were based on portfolios of mortgages, failed to take into account the fact that the riskiness of these individual mortgages could become highly correlated. Okay, and as a consequence, securities were dramatically mispriced. So that sort of fleshes out a bit the first step in our approach to risk management. The second step, in this second step, we will then discuss how financial markets can help to manage risks and to get rid of them, to hedge these risks. We will also ask the question whether we should hedge all risks or not. That's a very important and crucial question. In the third step, we will then critically discuss and evaluate these models that allowed us to quantify risks in the first place, but also the chosen hedging strategies. Ultimately, we will ask the question of how to preempt or mitigate the buildup of so-called systemic financial risks, which is at the heart of the interest of the Bank of England, but also how to improve the risk management process as such. Okay, so far, most of what I've said concerns either financial markets or financial risk, hence the title of this module. However, in the last part of the course, we also talk about different kinds of risks. Okay, not only financial risks, but also, for example, operational risks. Okay, think of fraud of an employee, maybe, or regulatory risks. Moreover, we are going to think about potential new risks that emerge on the horizon and how financial markets might be helpful in tackling them in the future.
I guess the whole syllabus of the module was developed not just from an academic perspective, but also how some of the concepts or which concepts are actually relevant to the daily, sort of the day-to-day workings of people within central banks. And there's always been a very fruitful exchange both on the academic and on the central banking side. So let me go back to Pelagia and to try sort of tease out a little bit how this course or this module could be relevant for people working in central banks.
I think looking at this from an academic perspective, first of all, brings rigor into the way we estimate and understand risks. As Lorenzo mentioned before, models might work in certain circumstances, not in others. You can always take a very macro view, but that avoids understanding the complexities of the microstructure, behavior of participants, or even the way the risks are correlated or interacting with each other in crisis. So it is very important to have the appropriate tools for the complexity of the problem. So academic research has always informed policy development. Central banks, in fact, have academic collaborators who they publish joint papers with. And this is very helpful to advance the debate or more important policy and regulation topics. It also supports us judge the effectiveness of regulation and keep revising them as it's needed. At the Bank of England, especially, we sometimes run academic roundtables where we bring specialists to discuss their research relevant to the effectiveness of policy tools and also the ideas for the development of new ones.
I do hope you've kind of enjoyed our little discussion here, and I'm really going to thank Lorenzo and especially Pelagia to join us today and give a little bit of an insight of what to expect in this module in the Global CBQ program. Thanks a lot, everybody.